All right. Well, hello, everyone, and thank you for joining us to have a preview of our 2016 Tax, Regulatory, and Risk Management Conference, which will take place in Orlando, Florida on October 30th through 31st. I'm Scott O'Brien, the Senior Manager of Finance and Tax Policy for NBAA, and we wanted to have this webinar to give you a preview of our session on business aircraft sharing, tax, and regulatory implications. So I'm very happy to introduce Joanne Barbera of Barbera & Watkins, an aviation law firm in the Kansas City area, and Stuart Lapioker of Lapioker Jet Counsel, also an aviation law firm in Fort Lauderdale. Both Joanne and Stuart are past chairs of our tax committee and have extensive experience working with clients on a range of aircraft sharing options, which they will be describing on this webinar and in detail during their session. So the tax conference occurs the 2 days before our Business Aviation Convention and Exhibition in Orlando, and all registrants of the tax conference also receive pre-registration to our convention. Again, it will take place October 30th through 31st in the Orange County Convention Center. Last year in 2015 was a record year for tax conference attendance, with 344 attendees representing 256 companies from all across business aviation. And we had a wide range of job titles and positions, from presidents and CEOs of companies to CFOs and flight department personnel. So a very broad range of attendees. This year we're going to focus on assembling your ownership structure, as you can see from the graphic. So tying together how state tax, compliance with FAA, DOT regulations, and federal tax planning sometimes have competing interests, but all need to fit together to have a compliant ownership structure that maximizes your tax benefits for owning an aircraft. So with that being said, I'm going to turn it over to Joanne Barbera, who's moderating our session, and she will introduce the scenario and then get into some discussion about various aircraft sharing options. Joanne?
Thank you, Scott. In our presentation today, I'm going to be playing a role. I am General Counsel of Company A that owns a business aircraft and employs or contracts for pilots for that aircraft. We use the aircraft in our business all the time. We have some entrepreneurial executives, though, in the business that have setting up a separate startup LLC that is in a different business. They want to be able to use the plane for that business, and Company A wants them to pay for it. They can pay some for it, but they're not ready to have their own airplane yet. So we are going to talk about, and I'm going to be asking Stuart, whether we can have Startup LLC reimburse my company, Company A, for Startup LLC's business flights.
And I think, Joanne, it's important to understand from the beginning that a Part 91 operation, which is, I assume, what you're doing here, without having the airplane on a air carrier certificate or a 135 certificate, is how the aircraft is being operated. And unfortunately, under the federal aviation regulations, we're very limited in what a Part 91 operator can accept and when they can accept compensation. Under 91501, which applies to U.S. registered aircraft greater than 12,500 pounds maximum certificated takeoff weight, multi-engine turbojets, you really do not even fall into 91501 if you're going to be operating commercially. And under 91501, the limited reimbursement options are typically timesharing agreements, which we'll talk about in this context, some reimbursement for flying a demo flight in connection with the sale of your airplane, interchange agreements, which are really hour-for-hour arrangements with some modest payments for differentials, joint ownership agreements, and affiliated group transactions between a parent and sub, or even deeper subs further down the line, which we don't have here. We really just have two separate companies. So under a timesharing agreement, a timesharing agreement is where you lease your airplane with flight crew, and many of you will probably know that that's considered a wet lease, to another person, and a charge is made pursuant to 91501 for some very, very limited reimbursements. It's really the only wet lease that a Part 91 operator can enter into and receive compensation for.
So, Stuart, you've handed me a sheet with the time-sharing costs that are allowed to reimburse. And I want to make sure that I can understand this. So we've got fuel, oil, lubricants, and other additives. That's easy. Travel expenses of the crew, hangar and tie-down costs away from the aircraft base, insurance obtained for the specific flight, which we probably won't have here, but that could be nice, landing fees, airport taxes, and similar assessments, customs, foreign permit, and similar fees, in-flight food and beverages. I'm glad they can pay for their catering. Passenger ground transportation, flight planning and weather contract services, and then a time-sharing charge not to exceed the amount set forth in one above. So when people talk about the 2 times fuel formula, I guess this is where that comes from. I have a question, though. We often use contract pilots for our aircraft. Can I also pass along to Startup LLC the cost of those contract pilots?
Not really. You're really limited to what is here. Travel expenses, for example, you could not, where it talks about crew, you could not get reimbursement for the salaries of the crew, and similarly, you could not get reimbursement for additional costs associated with employing or engaging crew. It's a very limited list. The FAA is very specific about what can be reimbursed because they're concerned that this might turn into some sort of commercial operation and that there might be some sort of profit component, which theoretically can affect safety. So they're very limited in what you can reimburse. And in the specific answer to your question is no, you could not ask LLC, your affiliate, for reimbursement of the independent contractor charges.
And I guess that makes sense because with fuel prices so low these days, my contract pilots are not going to fit within number 10 here. So that's something to really think about as we do our planning here. Are there any other considerations?
Well, most Part 91 operations are not subject to federal excise tax. Unfortunately, the IRS views a time-sharing arrangement as a commercial transportation service. So here you have where the FAA looks at it as non-commercial, the IRS looks at it as commercial, and payments under the timeshare agreement would be subject to federal excise tax, 7.5% of the amount paid plus the segment fees. The timeshare agreement is considered a lease, and assuming that the aircraft falls within the size requirements, you'd have to make your filings under the truth in leasing rules, which require filing the signed copy of the document with the FAA technical section within 24 hours of execution and making a notice to the local FAA Flight Standards District Office at least 48 hours prior to the first flight. The third item that's on the slide, which is the NBAA small aircraft exemption, is an alternative that the NBAA worked to develop with FAA, which allows application of the 91.501 rules to smaller aircraft, such as helicopters and aircraft under 12,500 pounds maximum takeoff weight. And then whenever you enter into a time-sharing arrangement like this, we do suggest that your insurance broker and your carrier be advised. They'd be provided with a copy of the document. And a lot of times, a timeshare lessee will want to be added as an additional insured on the liability coverage. From an operating perspective, I think you should know that you, the operator, remain in operational control of the aircraft. The timeshare lessee is really just a passenger and very passive in the whole arrangement.
Well, thank you, and I hope this has been a useful introduction to our presentation at the tax conference. We will have additional session topics. How can multiple owners use share use of an aircraft, how can aircraft be shared between multiple related companies, details on other 91-501 options, including demo flights and interchange agreements, review of aircraft sharing options, including dry leasing and charter, and details on tax and operational implications for aircraft sharing. Thank you, everyone, and we look forward to seeing you in Orlando.
Great. Thank you so much, Joanne and Stuart. And if you have more questions or would like to see the tax conference agenda, visit www.nbaa.org/tax. And we hope to see everyone in Orlando.